Do we have Geoff ready to join us? Yeah. Geoff, Dennis, independent advisor, emerging market expert, joins us. Geoff, good morning. Thank you very much for joining us. Geoff, the three of us have been debating about, what and how to make of what happened last night. First up, I guess status quo, no changes on 3 rate cuts that's expected. Some may argue about the commentary being dovish, but what I want to understand from you, if the economy is doing well and inflation is sticky, how does the street or analyst or economist even expect a rate cut at this stage?
I couldn't agree more. I had expected that the Fed would go from 3 rate cuts to 2 rate cuts at this meeting. I'm very, very surprised they didn't do that. And I think it's inconsistent, frankly, with the rise in the increased forecast for GDP growth, which has gone up quite a bit since 3 months ago, and also a slightly higher inflation forecast. So I think it's very surprising that they still went for 3 rate cuts. And I think the market reaction will tell you the market was surprised as well. I don't know how they're going to fit 3 rate cuts in, because also you've got to consider the timing of the rate cuts vis-a-vis the election. The Fed will not want to start rate cuts just before the election or just after the election. So it does imply they're going to have to start thinking about cutting rates in June or July. And that still seems to me to be quite early. So I thought this was a big surprise today.
Geoff, I know global markets seem to be very excited, and I'm assuming it's the no news is good news in that sense. Wall Street went up 400 points. Asia looks good. Crude is doing well. Dollar is eased off. Bitcoin is rallying. I mean, risk on, risk off, everything's moving up. My concern is that if crude continues to stay elevated over the next couple of months, commodities are beginning to move up as well, given what's happening in China. Do you feel like 3 rate cuts today actually seem very unlikely for the rest of the calendar year, because there are going to be so many unknowns which are going to catch markets and regulators off guard?
Again, I agree. I think the key thing for me about inflation is that inflation is coming down. I focus more on the CPI. Inflation has got stuck, I should say, on the headline CPI just north of 3%. The core is coming down, but very, very slowly. Okay, the core PCE is lower for sure, but there's just not enough progress there towards the 2% level to justify 3 rate cuts. And then you are absolutely right. You bring in a really important factor here, that oil prices have now broken out of their recent trading range. It was a very tight trading range. And that's going to push inflation up, not just in the US, but of course around the world. So I think what the Fed is probably doing, they're saying they trust that the economy stays reasonably stable, does not accelerate or anything like that. It could, of course, slow down. And the progress on inflation continues. And therefore, you get your 3 rate cuts. But frankly, right now, as we sit here now at the end of March, the case for a rate cut in the US is very, very weak indeed. So I'm just very surprised. And you brought another factor in there to, if you like, underpin the surprise, and that is the rise in oil prices.
Geoff, good morning. Tamanna here. One of the reasons being talked about, and I wanted to get your take on this and why rate cuts are still on the horizon, despite, for example, you saying that the case for it is weak, is because you have elections in the US this year. The anticipation of rate cuts has grown, and high rate cuts are actually hurting people as well. And do you think this is why the likelihood of rate cuts is very much there? Maybe once they start, it won't be a quick reversal of stance, but definitely 75 basis point cut is coming in.
Well, I published something earlier in the week where I said if you look at the election calendar, and bizarrely, the November FOMC actually begins on the day of the election and finishes the day after. I think if you assume the Fed will not want to start cutting rates the meeting before the election, and would also not want to start cutting rates the meeting after the election, because one move would upset one side and the other move would upset the other side, My best bet is they would have to start cutting rates in July, and then maybe they cut in November or December. But the politics makes this more complicated. The politics for me makes this decision still about three rate cuts very difficult to justify, frankly. Higher rates are hurting in certain parts of the economy. You're seeing a big increase now. Don't know about a big increase. You're seeing some sort of increase in credit card delinquencies. Obviously, with bond yields having moved back above 4.3 to 4.35 recently, although they've come down on the back of the Fed's meeting today, that is still holding the housing market back a little bit. But if you look at what the Fed has been talking about and their goals, and you look at how decent the economy is, it's just hard for me to see that the monetary policy outlook isn't changed from what it was 3 months ago. And specifically, I'm not sure how they get 3 rate cuts in, given their goals between now and the end of the year, given also the handicap to their flexibility that exists because of the election. Sorry.
I mean, having said that, there is no compulsion on the Fed to stick to 3 rate cuts, this year. This is an inference from the dot plot. The Fed has always said that they will watch the data and see what's happening next. Just want to understand from you, Geoff, implications for emerging markets such as India.
Very, very good. I think it's been a pretty dull year for emerging markets. We're just above the zero line. One of the things that's helping emerging markets to come back from being down about 5 or 6% earlier in the year is China has stopped falling, and that's helpful. You're seeing some big sell-offs in certain other markets, like mainly in Latin America. But you've seen some very strong markets like Taiwan, for example. Now, India is outperforming this year. It's up slightly in dollar adjusted terms, which is good. Based on my outlook for monetary policy and my outlook for the economy and inflation, I think EM puts on about 10% on the year, and we're up now somewhere between 1.5% and 2%. So this was a good day for EM because you're getting the classic signs that pull people back into EM: a weaker dollar, lower bond yields, risk assets doing well in the US. So I think all of this is good for the emerging markets. I still think India outperforms. I don't worry about the election with respect to the Indian market because I think we know probably what the outcome will be. As I've said many times on this show, I think the issue for India is always valuations. You need the growth to come through. You need the earnings growth to come through. You need to know that the inflation story is improving a little bit more. But at the end of the day, India looks better to me than China, and India looks to me like a small overweight. And I think this news today is very, very good for emerging markets.
Chair, good evening to you. Just one question really. Assuming that the Fed does what you're saying that might be difficult, which is 3 cuts, plus the comment about QT as well coming in from Jerome Powell, would you believe that risk assets would be higher between now and the end of the year if both of those things happen?
Yes, for sure.
For sure.
In other words, you're not going to get many days like you've had today, but the general theme will be, in other words, I've been saying to people that even if they ended up cutting the number of rate cuts in their plan or in their dot plot from 3 to 2, the narrative has not changed or will not change. That narrative is rates are at their peak, the economy's doing okay, inflation's coming down, heading towards 2%, albeit a little bit more slowly than we'd like to see. And ultimately, we don't really know when, but ultimately, they will slow down on the QT process and stop the QT process. I think if you assume if you assume as I do, that the dollar is overvalued, and after being pretty resilient so far this year, starts to come off, and you do see slightly lower bond yields, that is what I think gives you higher risk assets between now and the end of the year. And that will include EM, and this is why I'm very happy with my 10% call on emerging market equities in 2024.
We love having you, Geoff Dennis. Your views on the Fed and the resultant impact on EMs always help. Thanks so much for taking the time out and staying up for us.